We've made videos talking about Coca-Cola, which is very widely associated with Warren Buffett in the investing community. We've talked about how Coca-Cola has actually been an underperforming investment versus the S&P 500 since 1994, which is when Berkshire made its biggest investments and completed its cash investments into the soda company. Now, we're going to take another tack. We're going to take a look at the biggest competitor out there to Coca-Cola in the soda business, and that's PepsiCo. Talk about how PepsiCo has actually been the better performing business over the long term and why investors looking for high quality dividends and dividend growth, they want to look at PepsiCo instead of Coca-Cola. I'm Jason Hall. This is Investing Unscripted. Before we get into the details, just a reminder, this video is sponsored by The Motley Fool. If you're looking to up your investor game, you should go to our special link. It's fool.com/unscripted. Again, fool.com/unscripted. You see it right there on the screen. Go to that link and you can get access to the Motley Fool's best 10 stocks to buy right now. You need to check out that link. For those of you that watched our for those of you that watched the video where we broke down Coca-Cola, talked about some of the things about it that are good to know, this chart might look familiar. This is the performance of Coca-Cola stock plus dividends, total returns since the beginning of 1994. Now, Berkshire Hathaway didn't buy all of its shares at the beginning of the year. They owned shares before 1994, but using this as just kind of a starting point for the data can give us a good idea of what to look at. One of the things I want to add to this chart is I want to add the annualized value here, telling us on an average year, what did Coca-Cola stock generate in total returns for Berkshire Hathaway over that little over 20-year period now, 8.7%. Couple things. That's lower than the market's average annualized returns, which is around 10%. So, not a great period of time for Coca-Cola stock. Now, I'm going to add PepsiCo to our chart here. Definitely a better performing stock, 1,590% in returns, 9.7% in annualized returns. So, right around the market's long term average, a little bit below still, but right around that average. Now, guess what? Coca-Cola wasn't the only of these two stocks to underperform. PepsiCo also underperformed the market. Okay, so that's the history lesson. What about going forward? Why would anybody even consider either of these companies if they have a history of being underperformers? Where do they fit in people's portfolios and which one makes more sense to buy, if either of them? All right, so let's start with this. Now, yes, if you're going to buy stocks, if you're going to focus on buying stocks and building your own stock portfolio, you probably should be aiming to outperform an index. Now, that's true for most people most of the time, but that's not always the case behind buying dividend stocks and dividend growth stocks. Sometimes you just want to get better returns than another asset class. In this case, maybe you want to think about bonds. Now, again, the beauty of bonds versus stocks is it's incredibly rare that you see bonds lose a lot of value in a short term. Stocks can lose a lot of value in the short term. Both of these stocks have fallen 10, 15, 20, 30% or more within just a matter of months, multiple times over the past 30 or 40 years. So if you're talking about short-term money, meaning anything that you're really going to need in the next 3 to 5 years, these are not safer than just about any other stock that's out there. So let's get that out there. But if you're looking at something you can hold for the long term, and you're looking to grow the value of it over the long term, but you also want the income from the dividends and you want to see those dividends grow, both of these stocks, even though they've underperformed most of the stock market averages, have been better wealth creators than most bonds or bond ETFs or bond funds that you could have bought. So that's an important thing to remember that might make them good investments for you. Plus, maybe you just want some ballast, some high quality stocks that you can own. Maybe they're not going to outperform the market in the best of times, but when the market's not doing great, maybe they can create a little bit of value for you. I have a metric that I want to show you that shows why these two companies might still be good to hold if you have concerns about the economy, maybe not being super hyper growth, maybe some weakness to come, why these companies actually might still be good holdings. Okay, so we're back to our chart with PepsiCo and Coca-Cola. This is their annual revenue going back to 2000. Pepsi has certainly grown its revenue substantially more, does more than twice as much revenue as Coca-Cola does. A big part of that is that PepsiCo also has a massive snacking business, owns a massive snack foods business as well. And Coca-Cola has really just focused on beverages, and they're just starting to diversify even their beverage holdings a little bit more than mainly just sodas. So PepsiCo is a much bigger company, does a much bigger business, and has certainly grown its revenues at a much higher rate over the past couple of decades. I don't want to focus on the growth right here, though. That's great. What I really want to take a look at is when revenue declines. If you look on this chart, you see these gray bars here. These gray bars indicate times that there was a recession. So, of course, we had the recession during the pandemic. We had the global financial crisis, which was brutal. And then, of course, we had the recession in 2000, right around 9/11, the dot-com crash. A couple years of recession right there for the US. You see here, both companies saw their revenues dip. Coca-Cola's revenue fell a little more than 10%, fell closer to 6 or 7% for PepsiCo. And even during the global financial crisis, both of these companies proved incredibly resilient. Generally speaking, for both of these companies, even when their revenues do dip, they're not massive dips, and they also tend to recover pretty quickly. Now, part of the reason that's the case is because these are premium brands, but these aren't expensive things. These aren't cars or jewelry or consumer electronics, things that cost a lot of money. And one thing that we do know is that during tough economic times, people will still pay a premium for their preferred brand of certain products, whether it's cosmetics, whether it's snack foods, certain treats like that. People want to reward themselves and treat themselves a little bit. And maybe you can't go buy a new car, but you know what? You can buy a Coke or a Coke Zero or a Diet Pepsi instead of just buying the store brand and spoil yourself every once in a while. So that's something that tends to benefit these companies. Now, of course, they do have their big brand power. They have lots of pricing power as a result of that. Because of their scale, they have some cost advantages. Very, very profitable businesses at scale. Okay, so we've made the case for, yes, they've been underperforming stocks over the long term, but why they might still be a good fit in people's portfolio. We've also talked about some reasons they might be interesting now if you have economic concerns, thinking about maybe a weak or soft economy. Still some real strong value with the brands that these companies own. Now, let's make the case for why between the two, looking at Coca-Cola and PepsiCo, why I think PepsiCo is really attractive right now. So we're just going to start here with valuations. We're just going to start with the earnings multiple. So earnings multiple, price to earnings ratio. Coca-Cola, yes, historically has traded for a higher earnings multiple than PepsiCo. Part of that's because it's a little bit more higher profit business. In other words, gross profit and the margins they get are a little bit higher. So the market's always been willing to pay a little bit of a premium to it. Of course, there's that Buffett association too that I think probably lifts its valuation. Right now, trades for about 27 times earnings. That's certainly a lot lower than its 37 times, 36 and a half times price to earnings ratio over the past 10 years. Now, looking at PepsiCo, trades for about 25 times earnings, below 25 times earnings. That's lower than its 26 times earnings that it's traded for over the long term. So again, maybe this is a little bit of bigger discount for Coca-Cola, but I think the quality of earnings from PepsiCo right now, I think I prefer it. And it's still trading for a bit of a discount as well. Now I'm going to take a look at price to operating cash flow. So price to cash flows, a useful metric to look at right now. Coca-Cola trading for about 26 and a half times versus 22 times its long-term average. PepsiCo, long-term average about 18.5 times, trading for less than 18 times right now. So on a cash flows basis, again, I think PepsiCo comes out ahead to me. One more thing. Let's look at dividends. We'll start with Coca-Cola. You see a 2.78% yield for Coca-Cola. That's below its long-term average of 3.1%. 3% dividend yield for PepsiCo. That's above its long-term average of about 2.8%. What does that mean for both of them? It's an indication that you're getting a better valuation with PepsiCo than you are with Coca-Cola. Now, there's more to it with the dividend too, because you don't just want the yield, you want the dividend growth. PepsiCo has been a better dividend grower over the past decade. Its dividend has more than doubled, up less than 60% for Coca-Cola. Both are pretty good. PepsiCo comes out ahead to me. So what's it all mean? Depends on what you're looking for as an investor. If you're looking for the best market-beating stocks, maybe they're not the right fit for your portfolio. But if you're looking for the likelihood of earning money, making pretty good returns, probably going to be better than the market when the market's not great, maybe when the economy's soft. You want pretty good results, you're going to get that. You're going to get a great dividend, get some dividend growth along the way. Both look pretty interesting, but between the two, PepsiCo comes out way ahead.